Hi there, and welcome to this fifth lecture of Banking Risk 2. Now we are going to start a new theme and cover liquidity risk. And this lecture is going to focus on the sources and measurement of liquidity risk. In this lecture, we're going to first of all give you a range of examples of potential crises that ultimately resulted in liquidity risk, both at the country level as well as the company level. Then we're going to explain what liquidity risk is, the various sources of liquidity risk, and then finish off by explaining a number of the measurement techniques a bank may use to measure liquidity risk. Here you can see just 5 country level examples of where there's been a stress for market liquidity. We have the Mexican tequila crisis, the Russian default, the Argentinian sovereign debt default and banking crisis, of course the global financial crisis of 2008, and then subsequent Greece banking and sovereign crisis of 2012. Now you might have known a history of some of these, and you're probably thinking, well actually, they weren't originally liquidity risk, they were something else. So for instance, we have the likes of the Mexican tequila crisis of 95. Now this was an issue specific to the foreign exchange rate and the budget deficit against the US dollar. So if you go into the history of this, it was a balance of payments crisis and an overvalued foreign exchange, which ultimately led to high inflation. Prior to the default, there was a large current account deficit. Now we're talking like minus 6.5% of GDP, which equates to a $20 million deficit. Essentially, the Mexican government had a large amount of corporate and government debt, which was all based in US dollars, and there was a big currency mismatch on the central bank's balance sheet regarding the Mexican peso and the debt that was based in US dollar. As the value of the peso declined against the dollar, the likes of foreign reserves fell from 30 billion US dollars down to 17, but by the end of 1994, the reserves actually dropped to just 6 billion US dollars. So the Mexican central bank really had a lot of US debt. It didn't have much foreign reserves to service this debt, but ultimately in 1995 there was an interest rate increase in the United States, which caused further people withdrawing from Mexico, selling off the Mexican peso, pushing down the value even further, and all this debt in US dollars, the interest rate was going up as well as the foreign exchange rate buying dollars was going up. So ultimately, Mexico defaulted. They simply didn't have the money in the right currency to pay for its sovereign debts. So in this example, I've talked about high inflation, talked about foreign exchange mismatches, I've talked about interest rate increases, but at no point did I mention liquidity. But at the end, simply did not have the money in the right currency to pay its debts. Thus, it ran out of cash. Let's look at another example. We can look here at the Argentinian sovereign default and banking crisis of 2001. Again, this is linked to currency. Originally, they pegged the peso and the dollar 1 for 1, but due to high inflation, this really overvalued the Argentinian peso. It wasn't worth 1 peso to $1. It also ran a very large deficit, minus 3.1% of GDP, totaling 2.4 billion US dollars. Given that the peso was heavily overvalued due to this pegging, there was a lot of hot money flows, people buying securities in Argentina rather than doing the likes of foreign direct investment. And ultimately, as the currency was seen as overvalued, and when it was devalued, potentially money was flowing out of the country and going elsewhere. And because of this overvalued, while they were doing this, they were increasing the level of debt based in US dollar, believing that the peso was pegged 1 for 1. Ultimately, the government had a debt around 45% of GDP, and quite a lot of this was in US dollars. But given that the debt was in US dollars and not peso, and the peso was heavily overvalued due to this pegged regime, when we realised that actually the peso wasn't worth as much as 1 for 1, this caused a lot of economic problems, the peso severely devalued itself, inflation spiked further, but really the shock that caused the default in 2001 was a bit of politics when they were voting for a change in their constitution, but ultimately the devaluation of the currency when they realised the peso wasn't near the value of the dollar. But there was also a devaluation over the border at its trading partner in Brazil, which also impacted this. So again, we've got a case of lots of US debt, currency falling in value, issues with trade partners, in the case of Brazil devaluing its own currency. So essentially, they didn't have enough pesos to convert to dollars to pay off the debt. In other words, the country defaulted. So again, we've talked about foreign exchange, we've talked about interest rates, we've talked about mismatches in debt and foreign exchange, but ultimately, the country ran out of money to pay the debt. I think if you look at the case now, when they did default, I believe a US hedge fund actually claimed one of Argentina's warships as collateral. So they seized a warship from Argentina to potentially sell to recoup the losses from the default. Now, the global financial crisis of 2008, obviously you probably covered this a lot during your studies already, and you'll have potentially covered the issue of securitization and the level of credit risk and leverage was very high within financial institutions. And quite a lot of banks relied on short-term borrowing to fund longer-term assets. But as credit risk increased and leverage was becoming unwound, then banks were not lending to one another, and banks requiring the short-term funding really struggled on the liability side of their balance sheets. So they couldn't access funds to service their assets. So as customers defaulted on the asset side, they couldn't have funds to support the liability side. So they were getting squeezed on both sides of the balance sheet, ultimately rendering some banks insolvent. So again, mention the likes of credit risk, leverage. But ultimately, banks started to run out of money to service their liabilities or to fund new assets. The 2012 Greek banking crisis and sovereign crisis. This was a more fiscal issue. The Greek government had racked up a lot of debt, and as their economy shrank, they were not receiving the revenue from taxation. So the deficit the Greek government was getting was extremely large, and they had to be potentially bailed out by other EU member states to ensure the value of the European currency, the euro, as well as preventing Greece as a country going bankrupt. But ultimately, Greece was on the brink of not paying back some of its debt because it didn't have the money to pay. So again, this kind of fiscal issue resulted in the Greek government not being able to pay its debts. So the common theme again is not having the money at the right time. So whenever a financial crisis hits, typically prices are depressed, whether that's currency, debt, assets, liabilities. And in order to prevent such depreciation in these items, then we need more liquidity, we need additional cash, more support, or more in reserve to stave off any sort of decline. I would highly recommend you to potentially go back and have a look through the various cases that are on the screen, do your own research to get a better understanding and potentially understand how other risks ultimately lead to liquidity risk. In recent research, it's been proven that prior to the financial crisis of 2008, that liquidity risk just was not the priority. I mean, if you look at the Basel Accords, Basel I and Basel II, they're really focused on credit risk, then market risk. Liquidity risk wasn't really a thing in the regulations. They just assumed from a credit risk point of view, if there's enough capital from a credit risk point of view, therefore any defaults will be able to have a certain level of capital to make sure the banks don't suffer in times of stress. But that didn't take into account the likes of liquidity or leverage. And following the crisis, as you can see the dates of this research, quite a lot of authors were arguing that really the likes of mismatches between assets and liabilities and access to short-term funding really needs to be increased from a regulatory point of view. And obviously following the financial crisis and subsequent research within Basel III, the likes of liquidity regulations and requirements were introduced. which we'll talk about in next week's lecture. So we've talked about country level issues. But what about individual liquidity crises at individual bank levels? On this slide, I have a few logos of various financial institutions that no longer exist, or if they do, they're not in the form as per the logos on the screen. And quite a lot of these were the largest failures at their time. And some of these examples are your case studies for the associated risk management professional body associate paper attached to the module that you can study following Banking Risk 2. So for instance, we have IndyMac, and this was the fourth largest US failure at the time when it collapsed in June of 2008. And really, this bank was known for its Alt-A paper mortgages, in other words, undocumented mortgages. Essentially, they were self-certifying individuals who could say, yep, I've got the money to pay for the mortgage, and therefore they were given lots of high-risk mortgages out to customers. And typically these mortgages were high loan-to-value mortgages as well. So really, on the asset side of this bank's balance sheet was full of really risky mortgages. They went through a rapid growth phase, and they really concentrated their risk on Alt-A mortgages. And as the US housing market started to slow down, then customer defaults on the asset side were going up. Obviously, nervousness got out. Then there was a large withdrawal on the liability side. So there's kind of a modern day bank run. About $1.55 billion was withdrawn within a month, equating to about 8% of its customer deposits was withdrawn. So it was really squeezed on the liability side as assets were going to non-performing loan status. So ultimately, the bank went bankrupt. So again, credit risk on one side, bank run on the other side, ultimately led to IndyMac not being able to fulfill its contractual agreements and defaulting. We'll have a much earlier case of the likes of Chicago, Illinois, and this was in 1984. This is a bank that looked to increase its portfolio and went to buy Penn Square. And Penn Square was a specialist lender who lent specifically to the oil and gas sector. So when it did a merger and acquisition of Penn Square, it really increased the bank's non-performing loans. And when there was a crisis in the oil sector and there was lots of defaults from that purchase, then the asset side of the balance sheet shrunk. This also caused a bank run on customer deposits to a tune of $10 billion in May of 84. So again, asset side was defaulting, customer deposit bank run ultimately led to the collapse of the bank. We have Washington Mutual at the bottom there, which at the time was the US's largest loans and savings association. But it was also kind of dubbed the Walmart of banking. In other words, stack it high, sell it cheap. And really, this institution really targeted like the lower middle class in the United States. And they were selling, complex mortgages and credit cards, so really focusing on consumer debt. But it was a case of sell, sell, sell. So this was really getting a bit risky because there was a high pressure to sell, so operational risk involved here. They were essentially selling products to people who couldn't afford them eventually. So as they had the rapid expansion, and then when the lower middle class started suffering in the financial crisis, then in June 2008, they noticed that, again, this bank was suffering, and this also caused a run on the bank. I think it was like a 9-day run, which took out about $16.7 billion, about 9-10% of its deposit base. So again, a modern day run on the bank was caused by the speculation that they were losing out on their asset side with customers defaulting. So we had original operational risk, selling lots of products, customers defaulting on the asset side, so operational risk, credit risk, ultimately caused a run on the bank. On here we also have Lehman Brothers. I think that's a well documented case you'll be very familiar with. They underwrote a lot of the credit default swaps. When there was lots of defaults on CDOs, everyone was going to Lehman Brothers, who wrote the credit default swaps to pay out, and ultimately Lehman Brothers didn't have the money to pay out on the amount of credit default swap claims it had. It was also highly leveraged. It was hiding its leverage on its balance sheet using Repo 105. do have a look at that case, Repo 105, what they were doing there for that. So ultimately Lehman Brothers didn't have the cash to pay for all the defaulted credit default swap claims and went bust. In the UK, we had Bradford and Bingley, which was a case of mortgages, mainly to self-employed, second homes, buy-to-let, self-certs. When they converted from a building society to a bank, they went on a rapid growth, relied a bit on short-term borrowing. Ultimately, their mortgage portfolio was quite high risk, lots of customer defaults, too much reliance on short-term lending to fund mortgages on the liability side, and ultimately went bankrupt as well. And the famous case of Northern Rock, based in Newcastle, where West University is, they also had a business model of borrowing from the money markets and lending out longer mortgages. Their mortgages, very high loan to value, in some cases 120% mortgages. In other words, if your house was worth 100,000, they'd give you a mortgage of 120,000, so you could do the house up, assuming that the property value would go up. They were giving these mortgages to people who couldn't afford them. When the economy slowed down, house prices started to drop, therefore the mortgages were even in further negative equity. Ultimately, customers would default, they'd repossess the house, but they'd have like a loan of 120,000 on a house that was probably now worth 80,000 after repossession. So 40,000 loss is one example, and that was happening on a number of occasions. But because their business model was set up that they relied heavily on the short-term money markets to borrow, when other banks knew the state of play and that Northern Rock was struggling, they really couldn't borrow off the money markets. No one would lend to them. The yield curve flipped, so they were paying more on short-term borrowing than what they were receiving on long-term mortgages, so their profitability was getting squeezed. And then this ultimately caused the famous run on the bank, which you may remember the pictures of people queuing down the street outside various Northern Rock branches. So again, you've got all these examples of various banks from different periods of time. Some are linked to credit risk, some are linked to operational risk, some are linked to counterparty risk. But at the end of the day, they all ran out of money. They ran out of money to pay for whatever was due on the liability side of their balance sheet. In many cases, these banks went bust, some were nationalised, and some were bought by other institutions. And they don't exist in the way we know them now. So do have a look at these various cases to understand what happened and what it resulted in. But despite me mentioning a range of different risks, at the end of the day, they ran out of cash, which is liquidity risk. So let's look at what the textbooks actually call liquidity risk. And as I've just mentioned, it's the risk of a bank unable to have sufficient cash flow to pay for its requirements. In other words, the money coming in isn't making up for the money going out. We don't have enough money coming in, we don't have enough stored money to pay what we need to pay. We don't have enough cash to pay for when our outflows are due. Or we don't have access to funding to pay any of our outflows that are due. Liquidity is very important to the banks. They need cash, they need liquidity to pay for the likes of interest on customer deposits. If you want to take your money out of the bank, they've got to make sure it's in there so you can take it out. It's also useful for profitable opportunities. If there's a gap in the market and you have excess liquidity, then you can use that to take advantage and potentially raise good assets. But ultimately, liquidity is always seen as a safety net for unexpected loss. But ultimately, if you don't have enough liquidity, as we've seen in these various examples, whether that's at the country level or at the company specific bank level, if you don't have the liquidity, and when liabilities are due and you can't pay for them, ultimately you default. You potentially become insolvent. Even if you're a very profitable bank, but you don't have the cash when it's needed, that can lead you into some serious problems, and you could still default despite being heavily profitable. And this is what you want to avoid and ensure that you have enough liquidity, enough cash to pay liabilities when they're due. So as I mentioned before, following the financial crisis, the likes of the Bank of International Settlement recognised that liquidity risk was a real problem. It acknowledged that typically when the markets are good, the economies are thriving, liquidity is not really seen as an issue, and potentially tends to get ignored when times are good, and it only becomes a problem in times of stress or depressed prices. People only get concerned about, oh, do I have enough cash to survive? The financial services, the regulator at the time of the financial crisis, also acknowledged in its analysis of the financial crisis that there was a severe problem of banks really when they tried to access short-term funding, whether that was from the lack of customer deposits or lack of access to financing from the short-term money markets. So lots of regulators at the time realised, okay, this has been overlooked. And following this, which we'll cover next week in more detail, is in the likes of Basel III, they introduced the new liquidity coverage ratio and net stable funding ratio as regulatory requirements for liquidity risk. The liquidity coverage ratio is short term, so that's coverage for the next 30 days, where net stable funding is more long term horizon, looking at access to stable funding over a period of a year and further in some cases. If we look at a few definitions, now these definitions are actually taken from the Central Bank of France, who provide some very good definitions during the financial crisis when they're trying to work out the various aspects of liquidity risk. And they obviously acknowledged the various types, whether that be market liquidity, relating to access to volume, whether that be assets or liabilities, and whether there was enough volume to be transacted without any significant impact to the level of prices. Because typically when volumes spike and people are selling this one really depresses prices. But if there's a large amount of volume at a specific time, then the likes of brokers may struggle to execute or have the liquidity to execute high volumes. They also refer to monetary liquidity, which really prefers more economic and more central bank focused. So typically in times of stress, you can see the likes of central banks either lower interest rates to try and make liquidity cheaper, or you do the likes of quantitative easing, where they buy off debt from the banks, print money to pay for that debt, essentially giving banks additional cash to then use to kickstart the economy. They also look at the likes of funding liquidity, whether this be from funding on the liability side from customer deposits, or whether this is funding from the money markets. And prior to the financial crisis, there was a lot of financial institutions, just as Northern Rock did, that relied heavily on the money markets for short-term liquidity, so short-term overnight funding up to 1 year potentially, to service longer dated assets. And then lastly, the likes of just bank liquidity, the ability for the bank to pay any immediate liabilities that are due. So they broke liquidity down into 4 definitions. So if we look at the banking liquidity, where can liquidity risk arise? And traditionally we say it's the mismatch between maturities in assets and liabilities, but also the size difference between assets and liabilities. What we mean by size is, for instance, you could have a small customer deposit base versus a large loan portfolio. But using that same example, customer deposits are also short-term, while assets also long-term. So there's a mismatch in potential size between the two and the length of the two there. And within the bank's balance sheet, typically banks do produce maturity buckets to highlight where there's funding liquidity gaps, if there's a surplus or deficit in various different time horizons. And they also break down the assets and liabilities into different categories. So you can see which portfolio tends to be large within the liabilities compared to an equivalent portfolio on the asset side of the balance sheet. But ultimately, liquidity risk exists where there's a deficit in funding and potentially the maturity and size mismatches result in the bank running out of cash when they need it to pay for liabilities when they're due. So over the years, and certainly leading up to the financial crisis, what actually changed? Why did liquidity risk change? Why did it become a thing? Well, over the number of years up until the financial crisis, as we mentioned before, regulators and risk managers didn't really focus on liquidity risk. It was all focused on credit risk. Well, over the years, traditional business models changed. Bank's business model is typically get customer deposits in, transform maturity length, short term, transform it into long term, and lend out. But obviously banks' business models changed. They stopped relying on customer deposits, which tend to be more stable, and they potentially borrowed from other banks on the short-term money markets, so their funding was more borrowing than stable customer deposits. Within this, of course, technological advances took over. Bank runs used to be people standing on the street withdrawing their cash, but as technology advances, we can withdraw cash virtually nowadays. So access to funds has become easier. Moving money around, whether that be assets or liabilities, on wholesale can be done very quickly on the internet. But also increased competition. Competition for your money was certainly amplified. And as more banks compete for your customer deposits, then potentially this leaves some banks being unable to access customer deposits because you haven't attracted enough customers. So this is forcing them to lend from other institutions on the money markets because they don't have the customer deposits. Historically, in the United States, banks could only accept customer deposits from the state the bank was in. But when this law was removed, then banks became more national and potentially smaller regional banks suffered when larger banks started entering the states and taking customer deposits away from them. But we can also see this in the modern times where banking activity spread across the world. So amplified competition from international competitors also become a problem. And if we look along the next horizon, we can think about cyber currencies and the challenges central banks may face when adopting a cyber currency from a liquidity point of view. Because technically, in many countries, cash is the most liquid form of asset. But when cyber currencies, if they do come about and centrally banked issued cyber currencies, then cyber currencies are going to compete with customer deposits. If the central bank administers a cyber currency, then if you're holding cyber currency, then does that not mean your money is held with the central bank? Therefore, you've took your money out of the banking system, stored it in cyber currency, which is potentially stored or administered by the central bank. And if this is the case, consumers might feel cyber money being stored with the central bank being safer than being stored in a financial institution. So then we might result in a deposit drain from banks as they store using cyber currency. So from a liquidity point of view, this could really hamper cash deposits if everyone moves to cyber. So this is kind of one of the challenges the industry may face and what the likes of the IMF are currently looking into on how cyber currencies may be administered from this point of view. But if we look back, trying before the financial crisis, then really it was the world of securitization that ultimately led up to some of the financial institutions facing liquidity crises. They were potentially issuing products that the consumers or even some of their own counterparts did not understand. If we look at the likes of collateralized debt obligations, mortgage portfolios were sliced into various tranches given their level of risk. As customers paid off their mortgage, then these interest payments were getting filtered down into the various tranches of collateralized debt obligations. But when customers started to default on these mortgages, then the lower credit rating collateralized debt obligations were going into default as the money didn't trickle down to these tranches. And then when these were going into default, they had credit default swaps attached to them, which were triggered. So the investor of the defaulted collateralized debt obligation would go to the credit default swap writer, who underwrote the default risk, so the likes of Lehman Brothers, to make the claim for this default. But then Lehman Brothers, not expecting this to happen on a mass scale, defaulted on the credit default swap itself. There's a bit of irony in there. So A very simple mortgage portfolio being sliced up into collateralized debt obligations with credit default swaps attached on top of them made a very simple product into a multi-layered, multi-responsibility transaction, which is very difficult to regulate, and because quite a lot was off balance sheet, unbeknownst to the investor. So the world of securitization through collateralized debt obligations, credit default swaps, and concealed leverage ultimately resulted in access to liquidity drying up when defaults spiked. This chart here does kind of highlight the difference between gaps in size between assets and liabilities, but also the duration gaps. So as mentioned before, where does liquidity risk come from on the balance sheet? It's the gap between assets and liabilities in size, but also the likes of duration of assets and liabilities. Obviously this is just a fictitious example, but ultimately banks have to manage liquidity funding gaps and duration gaps from a liquidity point of view, as well as what we already discussed in interest rate risk. From one of the core textbooks that's focused on liquidity risk, we can have a look at a simple balance sheet analysis here to see what assets and liabilities tend to be, well, liquid or non-liquid. Typically on the liability side, we'd say the likes of equity, obviously regulatory equity, certified contractual liabilities, and non-banking deposits tend to be quite sticky. They tend to be more stable, while you have other things on the liability side, which also includes some customer deposits, can be more volatile, and certainly the likes of trading and repurchase agreements can be very volatile and over a short period of time. But on the asset side, we also need to look at what assets are potentially illiquid. Quite a lot of the loan portfolio, certainly the longer term mortgage portfolio, is rather illiquid compared to the likes of trading assets and again reverse repos, which are more shorter term. Looking at the sources of liquidity risk, we have covered, to start with, the likes of market liquidity. In the examples of the country level financial crises we talked about, ultimately market liquidity or access to additional capital or funding from the markets, if that dries up, then that can have severe consequences to individual banks. So market liquidity, to start with, can result in issues on the funding side, certainly if banks rely on short-term funding to finance its assets. But from this table, for specific banks, on the liability side, liquidity risk can arise from bank runs, where customers just take out their money if they don't have access to funding liquidity because of market issues, and if there's any sort of mismatch between the loan deposits, then really access to funds or customer withdrawals can cause a liquidity shock on the liability side of the balance sheet. On the asset side, just as we mentioned in various individual cases from them banks before, the likes of defaults, loan loss provisions, potential optionality can all result in expected cash flows not coming in. And if you're expecting them cash flows to come in so you could pay them out on the liability side, then that's where liquidity risk could arise when your incoming halts, therefore you can't pay your liabilities. But there's also lots of issues off balance sheet, concealed leverage, the shadow banking sector, various speculation issues from derivatives, even some of your off balance sheet hedges may potentially go a way you are not expecting, resulting in additional payments for unwinding derivative contracts. So liquidity risk can arise from anywhere on the balance sheet, whether the asset side, liability side, or hidden off balance sheet. All these liquidity issues really need to be looked at from the Treasury Department of the individual banks. So just to reaffirm that, we can see that on the liability side, any sort of mismatch between loans, problems with customer deposits, runs on the banks. From a consumer point of view, any sort of lack of confidence in the financial institution, any reputational damage really needs to be mitigated, because this could result in a bank run. And if it's in the modern age, taking cash out electronically is very common. It can be done very quickly. On the asset side, defaults, issues with counterparties, or even if you're trying to sell off your assets in depressed markets, then the economic value of your assets could decline. So when you sell off your assets, you don't get as much back as you expected, which can lead you into running out of cash to service your liabilities. Here's an example of some previous assessment work where they're trying to summarize where sources of liquidity risk could arise and how it could affect a bank. Obviously, we've covered quite a lot there about the assets and liabilities, and we've mentioned the likes of our balance sheet through the derivatives, whether that be hedging or speculation. But also, we haven't mentioned the likes of the interaction with interest rates. If we go back to theme 1 and talk about the repricing model, which was all about net interest income, if this becomes negative, then ultimately that might hamper liquidity if you've got more going out than you have coming in. Going back to the start of this lecture, we were talking about the various country liquidity problems. Quite a lot of them resulted from foreign exchange rate risk, and where you're holding debt in another currency, and if your currency falls in value, then it becomes much more expensive to service the debt in another foreign exchange currency. So foreign exchange can really exacerbate liquidity problems if your currency is falling in value. Obviously that's within internally, but obviously externally we talked about the likes of funding issues from market risk and short-term access to funding, but ultimately overall systemic risk and the interaction between various counterparties within the financial system. If your counterparties start defaulting, then this could severely result in contagion, which will subsequently impact yourself and potentially other banks within the market. This diagram from research really shows the scale of where liquidity risk can actually result within a bank, and they do break it down into external and internal. Obviously external, really again covering the likes of systemic risk, market risk, political events, sovereign defaults. But internal, we've got third party, which liquidity risk can arise from the likes of credit risk, interest rate risk, and operational risk, as I mentioned before, and then various examples from the banks that went bust. But obviously if you look at specific liquidity risk on the balance sheet and off balance sheet, that's where it breaks it down into assets and liabilities. So really, within the Treasury Department of the bank, you can see the scale of various sources of liquidity risk. And now I hope to yourself it's becoming more apparent that historically, when people thought credit risk was the main focus for banks, well, yeah, I get that. Credit risk is the reason for all the regulatory capital requirements to make sure they're solvent in the case of lots of defaults. But it's not just solvency from a regulatory capital point of view. The likes of default can really hamper both asset and liability side of the balance sheet when it comes to liquidity risk. Again, following the financial crisis, from research, there was a call to action, and this diagram was used to summarize the various sources and implications of liquidity, whether that be from profitability, a cash flow or solvency issue. If you please find the paper from the reference in the bottom to understand this author's point of view on the importance of liquidity from both perspectives of market-wide scenarios and bank-specific scenarios, and how the likes of a market-wide issue in liquidity can impact firm-specific characteristics, ultimately leading to banks to default or face liquidity problems. So covering the various examples and highlighting where the likes of liquidity risk can arise, and as noted, it can arise from anywhere. Post-financial crisis, there was a large argument for additional regulations, which we have seen in Basel III, and a lot of justification to strengthen banks' liquidity positions, not only from a bank point of view, but also from a market liquidity point of view. And really, this is to prevent the likes of market failure before. But obviously, this call for action initially had resistance, and when regulators were trying to introduce liquidity requirements, there was a lot of arguments to say that there's no incentive for banks to hold liquidity because if they're holding cash, it's not actually doing anything. And if regulators force banks to hold more stable funding or better quality funding, then the price of this quality funding goes up. So banks were actually arguing that it's going to be more expensive to hold this liquidity from an opportunity cost point of view and from a purchasing point of view when getting the liquidity in the first place. But also, banks still assume that in times of liquidity stress, central banks would step in anyway and provide additional liquidity support, whether that be from lowering interest rates to ultimately reduce the payouts on the liability side of the balance sheet. Obviously, this would include slowing down or reducing the incomings on the assets as well. Or the banks would turn to the likes of quantitative easing to print money to buy debt off the bank's balance sheets, giving the banks more cash to lend out. And actually, we have seen, certainly following the COVID crisis in 2020, this is what actually took place from a liquidity point of view. As an immediate reaction to all the economic slowdowns around the world, interest rates were slashed and lots of central banks pursued quantitative easing, giving the banks more cash to lend out to support them from a liquidity point of view, but also to try and kickstart economies during times of stress and crises. But ultimately, the argument for having more liquidity is really to prevent the issue of moral hazard of relying on the likes of government to bail out banks or from the reliance of central banks to use their monetary policy tools such as lowering interest rates and quantitative easing in times of stress to ultimately mitigate the impact of moral hazard. If everyone has more liquidity, more stored liquidity, then at times of stress, then there wouldn't be such a scramble for access to liquidity. And if there isn't this scramble, the likes of people selling off assets to raise funds, then we shouldn't see as much depressed prices in times of stress. So the argument is if everyone has stable funding, then in times of stress, there shouldn't really be any sort of spiral in prices, which ultimately exacerbates liquidity problems further. So to finalise this part, when thinking about liquidity risk, banks need to ensure that they have enough to pay out when payments are due on the outflows. In other words, make sure they have enough money coming in so they can pay out when it's due to go out. We also need to think about, in times of stress, how quickly can they potentially turn around assets to sell them and turn them into cash without potentially shrinking their balance sheet from the prices dropping or sacrificing any interest payments that were due on such assets. They also need to think about, from a funding point of view, how much do they rely on the money markets for funding? Do they have more customer deposits that are stable? So if there was the likes of a bank run, they do have enough customer deposits and a diverse customer base, so not everybody would participate in this bank run. And finally, what is the counterparty creditworthiness of the financial institution itself? Because the more creditworthy it is, the more capital requirements it hits, the more likely it's going to have access to funding in times of stress, because other counterparties will not be nervous of this institution defaulting if it's got a higher creditworthiness and meets all the regulatory requirements. And this concludes this first part of the lecture. Hi there, and welcome to the second part of Week 5's lecture on liquidity risk, sources and measurement. In this part, we're going to go through some of the internal measurement techniques a bank may use to monitor its liquidity position. I must state to start with, this is not the regulatory measures. This is just measures that the bank can do in-house just to maintain or to get an idea of the level of liquidity on the balance sheet. Next week we will go through the mandatory regulatory measurement requirements. So first of all, liquidity risk measurement is obviously going to be heart of the solution when we manage liquidity risk. And part of this is really to start collecting data. But what data do we gather? Ultimately, the Treasury Department, when measuring liquidity risk, they're going to get data on essentially how liquid is the balance sheet, what is the funding gaps, do they have more coming in than they have going out, do they have the cash reserves to pay for anything that's due, or if there's the likes of a run on the bank and customers start taking out liabilities such as customer deposits, do they have enough cash enabled to do that? But also, they need to think about access to short-term funding. Does the bank have a suitable credit rating, and is it trusted amongst its counterparties in the financial market so it can get access to short-term funding if needs be? So obviously we start gathering data, and that's both balance sheet and cash flow data. Of course, they're going to look at that from a regulatory point of view, but also assess, do they have enough net funding to service their assets? When they do the internal measurements, they're obviously going to back test, potentially to say over a certain time horizon, was there enough liquidity? But they're always going to forward test as well. So do forward-looking stress tests to say, if we didn't have access to short-term funding from the money markets, would we be able to pay our liabilities when they're due? Obviously, from understanding the level of liquidity from various measurement techniques and the regulatory requirements, then they can manage that accordingly. And the management is really about what kind of business model do we have? Do we have the more traditional balance sheet, which is more customer deposit in and lend out long? Or do we have more of a complex contemporary balance sheet where we do rely on customer deposits, but also a mix of short-term borrowing from money markets to lend out long? And potentially look at the size of the funding gaps to assess what management is required. And then, of course, the role of the Treasury Department is to report this in line with the Pillar 3 disclosures and to allow shareholders and both regulators to understand the liquidity position of the bank. But as you probably see from the first part, liquidity historically was seen as second best. But nowadays, it's really to the forefront of risk management within the financial sector. So let's look at a few of the basic quantitative liquidity risk measures that banks can do in-house. And these are taken from the Matz and Hoot 2017 Liquidity Risk Measurement and Management textbook. First of all, we have the liquidity balance sheet analysis, which essentially looks at the balance sheet as a whole and just takes a view on the liquidity position. Then we have the maturity mismatch approach, where we look at both sides of the balance sheet and potentially pair them with one another to assess what funding gap we have and how that funding gap changes over different maturity buckets. And then lastly, we have the cash capital analysis, which was created by Moody's to assess how much liquidity the bank has to fund its assets. So the first balance sheet liquidity analysis, it really is a simple process. It arguably oversimplifies assessing the level of liquidity. So here we've got two banks' balance sheets. Pause the video and take some time to have a look and think to yourself which balance sheet is more liquid than the other. The best place to start when doing this sort of analysis is to look at the liability side and think about what is their funding structure. Do they have a reliance on customer deposits, or do they have a reliance on something else like money market securities? But also have a look at the complexity of the liabilities. Do they concentrate their liabilities on a certain type of product, or do they spread the funding risk across various liabilities? So if we look at these two banks, Bank B obviously has a high concentration of non-bank deposits, which ultimately mean deposits from customers, not other institutions. So that's more of your traditional balance sheet. But if you look at Bank A, they have a wide spread of deposits, certified liabilities, which could be the likes of money market loans that are subject to contract, but also the likes of unsecured bank deposits from other banks and other institutions. So there's a bit higher level of counterparty risk there compared with Bank B, who has slightly less. And they also have quite a lot of trading liabilities as well, so certainly from the investment arm of the balance sheet. So again, if times were stressed, you can imagine the likes of the trading book and unsecured bank deposits becoming under a lot of pressure, certainly from a price point of view. And if prices are declining, you could try to sell off these liabilities, then that could result in depressed prices. But then if we look at the asset side of the balance sheet, again, Bank B is more traditional. It has a high concentration of loans compared to Bank A, which has a good split of loans, trading assets and repos. Obviously, Bank B would suffer in times of high credit risk from consumers, where Bank A is more diversified. So it's really just a kind of speculation, suggestion, and really looking at the balance sheet as a whole and thinking how a bank is set up and is it very liquid. Overall, Bank B is your more traditional business model from a funding point of view and a balance sheet point of view, where Bank A is more complex, contemporary, and arguably faces more risk, but is a bit more diversified. Okay, now take time to have a look at Barclays' example from 2018. Using similar titles of the various products, we can do an analysis of the liquid assets and liquid liabilities by searching them from the balance sheet or looking at the Pillar 3 disclosure report and then surmising what the liquidity position of Barclays is like. And at the bottom there you can see a comment saying that Barclays' liabilities are evidently greater than their assets, meaning should the need for liquidity arise, then Barclays might struggle from a liquidity point of view. In the case of a bank run, quite a lot of customer deposits could be quickly removed, and this may hamper the overall funding structure of Barclays. However, I would suggest a good thing in the fact that from a regulatory point of view, having high customer deposits compared to the likes of trading liabilities and repos is actually seen as a positive. And that's only if your non-bank deposits, your customer deposits, are more stable. So if these are stable bank deposits, then actually from a funding point of view, you could argue it's a good thing. But that just shows you how subjective this sort of analysis is. And it really is a quite vague and subjective form of analysis. Because I could argue that this balance sheet is actually quite good, but you could also argue actually on the liability side it's really concentrated. So you could say they might face liquidity problems if there's runs on the bank. But if we look at the right hand side now and get an idea of some of the limitations of this model. The first one being it doesn't take into account anything to do with time, cash flow timing, length of maturity. It's literally a snapshot of the balance sheet. We're looking at the balance sheet, which is obviously subject to accounting rules, and we don't know if this is a book accounting or market-to-market accounting because it probably differs between products. It's easy to do book accounting for your customer deposits, but for your likely trading assets, it's probably market-to-market pricing. And of course, we're not looking off balance sheet, and there could be a lot of liquidity issues stored in the off balance sheet on the shadow banking or the derivatives portfolio and various other credit lines for these institutions. To summarise the limitations from the textbook where this measurement was taken from, again you can acknowledge the timing issue, the impact on accounting rules, the off-balance sheet position. We've just looked at the balance sheet as a whole. We don't know the overall market value at the time of when we look at the bank. So in times of stress, the prices of, if you're to sell off these assets or liabilities, are going to be a lot less than what we look at in the good times. Banks that heavily rely on commercial papers, as well as the likes of certificate of deposits, could struggle given that these are very short-term money market products, and there might be a lot of commercial papers or certificate of deposits on the balance sheet when we look at it, but these could be only overnight. So tomorrow when we look at the bank's balance sheet, it'll be very different. So various money market products with short-term horizons can potentially skew this analysis depending on when we actually look at the picture of the balance sheet. The next method is to look at the maturity mismatch, and this is basically the funding gap between assets and liabilities over various time horizons. So looking back to the maturity model within interest rate risk measurement, it kind of uses the same data and is ultimately a similar approach in the fact that we have the various time buckets and we compare assets and liabilities to work out what is the funding gap between them. So it is very similar to the maturity model. However, the maturity model is all about looking at economic value if interest rates change. This is just more of an objective view at the funding liquidity gap and see how the funding gap changes over the various time horizons. And in a typical bank's balance sheet, you will typically have more short-term liabilities in the form of customer deposits, and then their loan portfolio will be the longer-term assets. So the funding gap will change over time. So here's an example that's taken from the textbook, and you can see the size of assets and liabilities at various time horizons across the top, maturity 1 to 6. We could assume that this is 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, what have you. But obviously if you do it for a real bank, chances are it's going to be overnight, less than 3 months, 6 months, a year, and so on. But ultimately, we're looking at a quick calculation of the gap. So obviously in the first year you've got a good immunised match from a funding point of view. Then maturity 2, you can see that we have more assets than liabilities, and that's maintained as we go out through the 6 time horizons. In the asset amortization, what you can see here is the likes of the decline or the change in asset from maturity bucket to maturity bucket. So this minus 100 is 1000 minus 900, and so on across the time horizons. This marginal gap, this 100, is assets minus liabilities. So if you have minus 100 minus 200, that's where you get the 100. And that's why they're all positive, except in this last one, where minus 150 minus 50 is actually minus 100 here. So all the marginal gaps are positive except from maturity bucket 5. And the last column is really working out the cumulative gap. So this 200 is 1 plus 1, then you've got 250, which is 2 plus 50. Then it obviously is 250 minus 100 to get the 150 to end up with 200. So that's how we work out this table. So do take time to work out how we worked out the gap, the amortizations, the marginal gap, then the cumulative gap. And the reason we do this is then to plot it on a chart so we can have more of a visual view rather than looking at the numbers. So the first one here is looking at the gap. So obviously year 1, we simply had 2 columns up at 1000, therefore there was no gap. But obviously 2, we had more assets than liabilities, hence the yellow gap, and we had a larger gap at maturity 4. If we look at the next chart, we're really looking at the amortization, and we can see the marginal gap. And as mentioned earlier, the marginal gap is always positive except from maturity 5, where the assets is greater than liabilities. But if we do this for the real bank, we can use the similar table that we use for the maturity model, which breaks down the asset and liability by the various time buckets. And we can look at converting them numbers into charts, just as we have done here. And we can see certainly the likes of up to 1 month, which has all the customer deposits, for instance, on the liability side. You can see there's more short-term liabilities than assets. But as we go along, we can see that there's a lot more assets than liabilities. So what we might see typically in a gap is we'll see it negative to start with, quite stable in the middle, and then become positive. And this is the dark blue charts on the left hand diagram. Then if we look at this from the amortization point of view, we can see the profile over the time horizon again. And of course the marginal gap is quite interesting here, because even though it goes negative to positive for gap, you can see based on that amortization it's negative. It actually comes a bit more positive, but actually finishes up negative again. So it's really trying to interpret what does this actually mean. And if you have a read of this comment, this is a bit of a summarization of what you might suggest for Barclays and how it's set up from a liquidity funding point of view. Following doing that sort of funding structure exercise over the different time buckets, you could potentially look at how this could be improved by doing the likes of cash flow matching and potentially working out the size of the gaps at various time buckets and think, okay, how can we potentially plug these gaps if we need to, of course. And at various dates or maturities, you can think, well, I've got more assets than liabilities. Could this be improved? Can we close the gap? And potentially here, we've got examples where, okay, there is a 200 gap. How can we potentially close that? We can raise more liabilities in the form of various debts to plug the gap, to make the funding gap zero. So you could potentially propose solutions if the gaps are substantial at different time horizons. And the last form of quantitative analysis of liquidity risk is to look at Moody's net cash capital analysis. And this is a formula where we're looking at the cash capital. So again, we're looking at the balance sheet and looking at long-term funding minus illiquid assets minus illiquid securities to work out what is our cash capital, essentially what is the available cash we have on the balance sheet. And you can look at it from a pictorial point of view, from the asset side and the liability side. And then essentially when you work out the cash capital, you can compare the amount of cash capital relative to the size of the balance sheet to see what liquid position you have. And this was created by Moody's in 2002. So it's quite old now, and it is a long formula to go with it. So as I mentioned, you see the formula at the bottom. Net cash capital is long-term funding minus illiquid assets minus illiquid securities. But within that formula, you can see that the long-term funding includes a range of different liabilities. Very difficult to potentially get all this data from the bank's balance sheet. And then within the liquid assets and illiquid securities, you can see again the range of assets and items that you need to obtain, and then apply a certain haircut to the securities. So you don't take all the securities as is, nominal value. You have to take a certain percentage haircut to put it in the formula. So ultimately, to work out this net cash capital, you have to get a various level of granular data to do this. So it is quite a difficult task to do, and in some cases it's not actually possible to do. So this would certainly be done at the treasury level within the bank because they have access to this data. We've just seen the Barclays example, but what we've tried to simulate here is an example of a pre-crisis funding structure between the likes of Barclays, who survived the financial crisis, compared to the likes of Northern Rock, who didn't. And what you can see very quickly is the scale in customer deposits. Barclays had a 62% of customer deposits relative to Northern Rock, which only had 23% of its balance sheet. And you can see the amount of secured term funding, in other words, the borrowing of the likes of the money markets and the capital markets to finance their assets. So very quickly you can see that the more traditional bank funding structure for Barclays, compare that to the more contemporary and complex funding structure of Northern Rock, then it's very quickly to see why Northern Rock struggled to access liquidity. And if you did the measurement techniques, all three that we've just covered, on the likes of Northern Rock, you'd definitely notice some warning signs regarding their access to funding at times of stress, given the fact they didn't have much customer deposits and relied heavily on short-term debt and secured term funding from a funding point of view. But as well as the likes of the quantitative techniques, of course, within the bank, the management team will also have a more qualitative approach to looking at liquidity and really ask itself some deep questions about its ability to measure liquidity risk. Given the complexity of liquidity risk and the fact it can arise from anywhere, as we noted in the first part of the lecture, do they have the IT infrastructure essentially to do it? Do they have the data to capture where the funding comes from? Do they have the data to capture all cash flows? Do they have the simulations to stress test and back tests? How do they take into account various changes in interest rates, changes in the levels of credit risk, and so on? Do they have the infrastructure and the means to do all this? But also, does the bank have the likes of contingency plans in place? Do they have the relationships with various counterparties at times of stress that they know they can deal with? Do they have the collateral in place, the likes of T-bills, if they want to go to the lender of last resort the central bank to do a repurchase agreement. So from a kind of qualitative point of view, it might ask itself all these various questions on its liquidity position. And as well as this, it will of course set itself a risk appetite and potentially set its own limits and regulatory requirements as a form of costing and control exercise. So certainly from a risk management and risk appetite point of view, it might outline its limits when it comes to funding. How much does it rely on the likes of short-term money markets? What does the differential have to be between customer deposits and borrowing from markets? It will also look at the regulatory requirements and make sure that these ratios are hit. And then from an internal audit point of view, they'll set out the controls and procedures to monitor all this and stress test these liquidity positions accordingly. So in summary, both quantitative and qualitative tools for liquidity risk internally, they are very subjective. They're very scenario based. We might be looking at a snapshot of balance sheet at one point in time. Does that really reflect how dynamic a balance sheet is? As well as that, do we have the ability to collect the appropriate data? Do we have the appropriate scenario planning if things go wrong? Do we stress test the balance sheet in the correct way? Can we capture the liquidity on all sides of the balance sheet? Do we capture the off-balance sheet items? Do we fully understand how the fact market liquidity can impact our balance sheet liquidity? And all these various aspects we need to take into account when looking at these very simplified measurement techniques. So ultimately, measuring liquidity really is not a simple task. Next week we will go on to look at the regulatory requirements in the form of liquidity coverage ratio and net stable funding ratio, which was introduced in Basel III to help banks demonstrate that they're meeting international liquidity standards and that the likes of the bank does have enough cash over the first 30 days in the event of stress, liquidity coverage ratio, and then the net stable funding ratio, that they have access to longer term secured funding, again in times of stress. As part of your directed study for this week is read the liquidity risk drivers and bank business model paper on Blackboard, which is part of your seminar task. Do read the various liquidity chapters. If you want to read the traditional seminal literature on liquidity risk, the Diamond and Medignan paper of 1983 was the first of its kind to look at the likes of bank runs to understand the concept of liquidity risk in the bank from a research point of view. But as well as that, just do a good understanding and do a good research on liquidity risk. Look at the Basel Accords ahead of next week's lecture. Look at the bank you might have already chosen for your assessment to look at the liquidity section, have a read of the kind of language that annual report uses. But thank you very much for watching this lecture.